Time for the exchange, and in 2025 Ghana recorded notable improvements in key macroeconomic indicators, with interest rates, inflation and exchange rate pressures all easing over the year. But a closer look at the data reveals a critical concern. Despite sharp cuts in the Bank of Ghana's policy rate, borrowing costs did not fall by the same margin. This afternoon on the exchange, we want to examine how rising risk margins in the banking sector are weakening the impact of monetary policy on lending rates. Dennis Brown, Associate Director in the Strategy and Transactions team of Deloitte West Africa, joins me. He's written on that and he's going to shed more light on it. A great writer, by the way, Dennis, sorry. So the Bank of Ghana data for 2025 shows a steady decline in key interest rates and overall improvement in macroeconomic indicators. Yet, as you write, borrowing costs for businesses and households remain high. Can you explain why the positive impact of policy rate cuts hasn't fully translated into lower lending rates?
All right. Thank you very much, Daryl, and thank you to your viewers and listeners as well. I think that as the article puts it, the big policy cuts that we have seen is what drove me to the data. I wanted to look at how the average lending rate has trended with the monetary policy rate. And I did find out that, yes, whilst it's trended down positively, it could have gone down very much. Whilst it has trended positively, it could have gone down, by a higher margin than it did. So, with my knowledge as what constitutes the average lending rate, which is basically a combination of the Ghana reference rate and is a combination of the Ghana reference rate and risk margins that are built into the price by lenders. I quickly did the differentials and could really see that no, the risk margins are increasing over time at the same time that the monetary policy rate and the Ghana reference rate is also dropping. So clearly, the discretion that banks and lenders have to build an additional margin into the lending rate is either being abused, or perhaps there are genuine concerns in the market relating to risk that is then being built into the price. And this has, sort of held up the borrowing cost a bit more than it could have, looking at the rate of cuts that we've seen in the monetary policy rate as well as the Ghana reference rate.
So your analysis highlights widening risk margins as a key factor constraining the pass-through of the monetary policy rate. What exactly are these risk margins, and why have they increased so significantly in 2025?
Yes, one of the things we highlighted is that it's very important that Bank of Ghana, where a huge institution they are with all the structures, should look into this further. First, it requires some investigation, working with the banks and other lenders to identify where the risk factors are, or what causes these, risk factors, and to see how best we can use a combination of policy and regulations to mitigate that. But on my own, I identify a few things based on, general knowledge of what constitutes risk margins or considerations by lenders, for risk margins, and I listed a few of them there. One of them relating to credit risk, where there's a sense that we are in a tough environment. The banks thought of it that we are in a tough environment, or we've seen significant improvement in the macroeconomic environment. But if they are running into bad loan books, they think that environment is still high risk, they are going to price that in there. And so what we are asking for Bank of Ghana to do is to work with these banks to ensure one, prudent and strict implementation of their own credit risk management, as well as to see whether there are excesses that can be standardized, because that then gives maybe too much room for banks to operate in and to abuse their discretion. We also talked about project risk, where there are specific projects that banks may assess at high risk because of the risks attached to the cash flow. And that we think typically comes from not structuring the project well, where you don't get the cash flow profile, structured properly. And this can stem from you not working with experts like financial consultants that would see through the lines and help you structure the projects well. you are likely to, end up in a situation where banks want to do the deal, but they see the risks, and so they have to price it into the margin. There are other things around loan security and collateral where documentation has been an issue. Look at our land administration system, for instance. It's very difficult to register properties, even those that, genuinely belong to you. So where there are these deficiencies in terms of documentation, banks that see the opportunity may still want to go ahead, but it will come at a higher cost, which is built into the risk margins. Then the general market conditions, we've seen significant improvement, and so would have expected that this would follow in terms of how the risk margins drop, but that's not what we are seeing. And so it tells us that either the banks are, abusing their discretion over the risk margins, or there are genuine concerns in the market that Bank of Ghana can work with the fiscal authorities to address. We also have other factors around industry, specific risks like oil and gas. Some of the risk weightings that Bank of Ghana will assign some of the projects there because of that industry will be high, and the banks will run along with that. And so what we are saying is that some of it could relate to structuring of the industry itself. We have an industry that is capital intensive, and so we have a lot of the funding coming from foreign sources, and so the inflows are routed directly to foreign banks. And we've been on platforms where the banks have complained that, if you're not retaining a significant amount of the inflows, then, it reduces the confidence with which we approach such projects, because we also want to see the cash inflow retained here so we can, leverage same to repay loans in that sector if we give out loans in that sector. So those are some of the things that Bank of Ghana can deal with, including regulatory requirements, how they can look at some of the regulations that are overly stringent and can be relaxed. And where we have to do with industry specific risks and specific regulations from Bank of Ghana, which has the banks obeying certain rules. We have indicated that yes, Bank of Ghana can investigate, but to be able to achieve maybe a relaxed rule that can work for everybody, that will require investment in systems and structures that will allow for effective and tailored risk management and monitoring, as well as timely response to risk incidents. Once you have these systems in place, it gives confidence that the risk will be tracked earlier on and the response will be swift and adequate, and therefore from the onset we can work with reasonable margins rather than pricing in higher than expected margins. We also talked about profiteering from banks. It's not impossible that banks may see the opportunity, and where competition is not that tight, they may abuse the discretion they have to build in higher than expected risk margins. These are things that Bank of Ghana can look at, investigate further, work with other fiscal authorities to implement measures to address.
Well, given that the monetary policy rate was cut by 900 basis points last year, but lending rates fell more slowly, how does this affect the effectiveness of monetary policy in Ghana? I know you talk about some of the things the central bank can do, but are there limits to what the central bank can achieve through rate adjustments alone?
I mean, we know that in between the monetary policy rate and the final lending rate, there are other factors that also play out. And that is why you are never likely going to see a one-to-one mapping. So the monetary policy rate goes down by 900 basis points. You cannot expect the lending rate to also go down by 900 basis points. No, because there are other factors that play out there. But what we are saying is that we look at the risk margin that banks using their discretion are pricing into loan deals. And that alone, if you hold other things constant, are slashing the potential full impact, which is the 900 basis points that the monetary policy rate could have had on the lending rate by half, almost half. I think about my calculations was about 420 basis points is how much the risk margin has increased over time. And so if Bank of Ghana can work with the the banks, the fiscal authorities that manages fiscal policies, Ministry of Finance, etc. They will be able to address some of these factors that I have laid out. But like I said, it will always require investigation first to ensure that yes, indeed, these are the factors that are playing out, and to then address them. So yes, it is constricting the impact of monetary policy rate significantly. Whilst we do not expect for a full pass-through effect, we believe that the pass-through effect can be to a greater extent than we have seen, and that therefore can lead to a higher decrease in borrowing cost, which will be good for us here.
And what factors could be credit risk, project risk, regulatory requirements, or lender practices driving these higher risk margins, and which ones do you see as the most critical to address?
Yeah, I think that all of them are critical. Maybe where we see low-hanging fruit is profiteering lenders. So because there's some discretion around your assessment of borrowers and the margins that you price into loan deals, that is an area where banks or lenders can abuse just for purposes of profiteering. But we have indicated that can be addressed through competition, because if a borrower has access to various options, maybe 5 banks that want to give the loan, they are in a good position, in a strong bargaining position to bid down the risk margin. So that we think policy and regulations can help address that as low-hanging fruit. But there are some of the things that are also structured, like Bank of Ghana has a rule, or risk weightings for various types of projects, which with the right investments we believe they can relax those rules. But the right investments would have to precede that. You invest in the systems that effectively monitor and timeously respond to risk incidents, then you can lower the risk margin, because the probability that that risk will have the anticipated impact can then reduce significantly.
So yeah, based on your analysis, what steps should the Bank of Ghana and other fiscal institutions take to reduce risk margins and improve the transmission of policy rate cuts to borrowers, and how could this impact lending rates and overall growth of the economy?
Yeah, it's one simple thing, though. I think that's policy coordination. And 2025, we've seen a good amount of that. And I think the Bank of Ghana governor has indicated severally in some of the press conferences that they have ensured that there is proper policy coordination between the Bank of Ghana and the Ministry of Finance and other fiscal authorities, so that they are all moving towards the same objective, although they have different and distinct roles, right? That has to be improved further, and that I believe is what can result in a significant reduction in these risk margins. Because all these factors, as we listed them, for most of them we have indicated Bank of Ghana to work with other fiscal authorities. Of course, for some of them they would have to rope in the banks, the lenders themselves, because you still want to retain some discretion at that level to encourage competition. We run a free market system, so you can't just say everybody should give out loans at the Ghana reference rate. Every one of them will look at their own assessment of the project in front of them and pricing the risk. But we also don't want a situation where they have such a huge margin of discretion that they can abuse it. And so it's important that that is guided as well. The impact on that, if they can achieve it, will be to significantly reduce borrowing costs. And when borrowing costs is reduced, overall cost of capital goes down. It will improve access. Businesses and investors will find capital cheaper, and then we invest in the high growth segments of the economy, expand the economy, create more jobs, going forward.
All right. Thank you so much, Associate Director, Deloitte West Africa, Dennis Brown. I appreciate your time.